So what are the cons of infinite banking or the bad parts of infinite banking? Hey, listen, I love infinite banking and there's a lot of great benefits, but there can also be a dark side to it. Well, let's talk about what those are in this video now. All right, so it's no secret that on this channel, we love using infinite banking, especially when it's max ROI infinite banking like we teach. However, there are also some bad negative sides of infinite banking. In fact, every time people will ask us saying, okay, we hear the good stuff, but what's the downfall? Well, it depends on how you have it set up, and I want to kind of dive into each of those points to let you know here's what to watch out for if you're going to be doing infinite banking. All right, so the number one downfall I see for people that are trying to get infinite banking is first and foremost, they start with a policy that's not the best for them. Unfortunately, even though infinite banking, you've got so many infinite bankers and people out there beyond just myself teaching this kind of stuff, the one problem is this, is that it varies just as much as the insurance companies vary, and it varies as much as the agents vary. And the agents can pull different levers and triggers and things like that to be able to make the policy more efficient. Unfortunately, here's what is the reality. Insurance agents are humans. Although they have good intentions, I think the vast majority of them do want to help you. Most of the time, instead of trying to give what's best for the client, or the best, what I would say is like, what would they set up on themselves and their family members? They do differently for their clients. And if they do the same as they do for their family members, you start to wonder, well, do they know the best, right? Because do they really know how to make it really be efficient? I'll tell you, so many times I've had insurance agents reach out to me saying, how do you get the numbers that you get? I can't even replicate that. How are you able to get it so good? And the reality is, it's because I've been trying to perfect it over the last 15 plus years. Really, I've been doing this for almost 20 years, but it's really been the last 15 or so years that I've been really trying to dive in and pull the different levers to get the biggest, really get the biggest juice out of that squeeze, right? Like, how do we get the biggest out of it? And so a lot of times it is based on the insurance agent. Who are they? You know, are they giving you the best deal? Or are they trying to come up with a win-win where they make more commissions, not all the commissions they can make, but at least a good chunk of it, while you still get a little bit of money too. So they try to compromise. And to me, that's the number one issue right there, is that it's not that it couldn't be good, it's because they don't give you the best, even for the insurance companies they're running it for. You know, to give you an example, I actually had somebody who showed me their Northwestern Mutual policy. Now, Northwestern Mutual will tell you every time that their number one thing, why you should use them, is because they're big, because they're a big company. Why are they a big company? Because they charge the most in fees. You know, I had this example where this client sent me, he said, well, here's what they gave me. Can you beat it? Well, the first year he put $22,000 in their policy, $400, $400 is all they have. That means almost all of that $22,000 is going to insurance costs. Where with ours, instead, he had roughly about $17,000, $18,000 in there. Not $400, but he already had like at least $17,000 more than the other one. And that's just from the first year. Every year it was cheaper as well. And it kept growing beyond that. It kept compounding and getting better to where it's like tens of thousands of dollars better, even to the hundreds of thousands of dollars better in like 20 years. Only difference is, one, it was a different insurance company, but two, it also means because that company did not train their agents to give you the best. They trained their agents to make better commissions. Be aware of that. There are so many bad policies out there. And I say bad because it's not that they're illegal, it's just that they can be done so much better. All right, here's another con with infinite banking. Now, again, I'll give a shout out to Nelson Nash and the Infinite Banking Institute. They've done a lot of great work. That's where I learned about this. I was a financial advisor, never knew anything about infinite banking. But one of the cons I see out there is that a lot of people will read that book, you know, Nelson Nash's Becoming Your Own Banker. Great book, great read, by the way. But then they'll take the things that were true in the current economic situation back when he wrote the book, which was decades ago, and they try to apply it to today. So for example, people will say, oh, the best way to use this is like a bill pay account, which I know even he would disagree with if he were alive still today. But they would try to use like a bill pay account. Just pay all of your bills using this. Or, you know, we recapture dollars, as they say, right? Or they'll say, buy your house or buy your car with your policy. Now understand, the people he was talking to were the people who are like Dave Ramsey fanatics, right? These are the people that insist on having no debt at all. So what he would teach them is say, well, instead use the cash value from your policy, but instead you can actually borrow from the insurance company, which does charge an interest rate. So ironically, it's like a loan or a debt. They'll charge you interest, and then you'll use that money to pay off your car loan or your house loan or whatever it might be, or you pay your car in cash using the funds from there. Now, if you borrow from the insurance company, yes, they do charge you interest. You do not pay yourself back. That's another lie that you'll hear out there, is they'll say you pay yourself back interest. No, you do not. They charge you interest. Now, when you use the money that you would be paying a bank normally and you pay it back towards the insurance company, it's still a principal and interest payment. The difference, and here's the benefit, right? If I go on the flip side of the con of that point here, is that the benefit is at least you don't have a required minimum monthly payment. It's not on your credit report. It doesn't show up that way. The argument could be made, well, Chris, at least I know I won't destroy my credit. I can use this. I can pay it back however or whenever I want. There's no minimum monthly payments. I can not pay anything at all because it's guaranteed it keeps paying me interest. I could be okay and not pay this back. That's true. Because if you did that with the bank, you go 30 days late, it destroys your credit. And of course, now you're dealing with all the other issues too that come from that. And so to put your livelihood at ease, yes, that could be a better option potentially. But so is just paying all out in cash or being debt free. So just be aware of that a lot of times they're trying to tell you to just be your own bank and go and finance cars and houses. Here's what I'll do. I won't pay off student loans with that, cars or houses, because if it's a low interest loan I can get from the bank, I'm not going to use this money. Now, if it were a difference between me using a credit card versus this, I'll go with the life insurance every single time because they charge a much lower interest rate. But I'll tell you, I bought a car at 3.99% financing. I could have paid it in cash, but when they offer me 3.99%, I know for me as an investor, I can make a lot more than 3.99%. Furthermore, the reason I didn't use my infinite banking policy to go and buy that car and I used the bank's money instead is for two reasons. One is I knew that the loan rate for the insurance company was going to be 6%. So why would I pay a higher interest if I can get a lower one at the bank? Now, let's just for argument's sake say we're about the same interest rate. The reason I still wouldn't use my infinite banking policy is because of this. That cash was hard-earned cash that I put in. I'd rather use that money to make me more money. But if I can get bank money for a relatively decent interest rate, to me 8% and below is a decent interest rate. If I can get money from the bank at 8% or less, I'm going to do that all day long, get the cheap money from the bank, and let that money that's in my policy, use that to go and invest and make more than 8%. That's what I would do personally. Everybody has their own different options, but that's one thing, is that just understand you're always paying interest to somebody. If you're not paying it to the bank, you're going to be paying it to the insurance company. And yes, those interest rates can be a little bit higher than the options they're telling you. So just know as using this to pay cars or houses may not be the best option for you. Here's another mistake people make, is that they get so excited that they can leverage the cash in their policy that they go and they try to maximize it all the time. Even some of my own clients. And people will ask me, they'll say, Chris, do these policies ever fail? And I'll tell you, it's very, very rare based on how we design it. I've seen a lot of other policies fail before, but ours is very rare because we make them so low cost that once you get cash in there, it works great. My recommendation is if you're going to put cash in, build up some savings, build up a buffer that you're not utilizing. You're not just pulling all that money out. Because here's how it can blow up, even for our designs, which are amazing. The way you can blow it up is if in that first year you put in the money, you pull out all the available cash in there to go do whatever you're going to do with that money, and then the next year you can't pay the next year's premium. Now, if you did that, then yes, you will be in trouble. You got to pay at least the minimum premium that's set. And by the way, the minimum premium is usually less than the max, and that's a whole nother conversation. But if you can't at least pay the minimum premium, you're going to lose the policy. Now, granted, you already pulled a bunch of the cash out, so you kind of haven't lost everything. But the problem is if you don't have cash in there to keep it going, then you're going to run into a situation there. I'll give you an example. I had a client where he bought policies on his kids as well. Now, when times were rough for him for a few years, he couldn't pay the premiums. But fortunately, we designed the policy to where there was cash in there the whole time. So because there was cash in there, the insurance company was able to pull from the cash that was in there to then essentially pay back into the policy, right? So they were borrowing from the cash to put it back in and allow that count to keep growing or not at least diminish as quickly, allowing that policy to last for many, many years even without him paying a dime into it. That's very possible for most of our clients. I've had so many clients, especially in the last few years, if they've done real estate investing, have bad deals and say, well, Chris, what happens if I don't pay this premium? I said, well, good news. You've got more cash in here than what your minimum premium is. Let's just have them borrow from that cash, which essentially is like taking out of savings to put it back in savings. Just do it that way. And they're elated, they're thrilled because they know they're not just restricted, where if it's like a term policy, you don't pay 1 month, it's gone, you've lost it, right? So you do not want to get caught in that situation. So again, it comes back to designing the policy the right way so that you don't lose it. But again, don't just strip out all your cash from day one and then of course never pay into it again. That's not going to work. Well, here's another big issue. Now, this is not a con of infinite banking per se, but it's a con of all insurance in a sense, and it's really a con based on your action, which is you wait too long. You get older. Every year you get older, it gets more expensive. If you wait, trying to hope that your health gets better, well, what if it doesn't get better? What if it's great right now, but it's not better later on? Well, that situation could put you in a pickle, right? Because what if something happens to your health? As an example, I had one client where fortunately, we not just bought a whole life policy, but we also bought a convertible term policy. Convertible term allows you to convert to a whole life policy without requalifying your health. Well, a few years after we got those policies on him, he reaches out, he says, Chris, I have a brain tumor, it's inoperable, I am doing some different treatments and whatnot, I'm hoping to get rid of it. However, I'm a little scared, but I have my insurance in place, right? I said, yep, you got the whole life and you got the term policy. Luckily, a year and a half later, the cancer's gone, it's in remission, he's feeling better, but he's uninsurable at this point. But he has this term policy that he can now convert to whole life at the top health rating. Even though they know he had cancer, they cannot deny him that top health rating. So I always encourage people, even if you can't get an infinite banking policy or a whole life policy today, at least get a convertible term policy you can convert later on, especially while your health is good right now. We have no guarantees. I've even had people younger, a woman that was about 30 years old, that something happened between one year to the next that she went from top health rating to uninsurable. And once again, luckily we got that convertible term that we were able to convert. Even though the insurance company knew she was uninsurable, they had to give her a whole life policy at that top health rating. So here's what it comes down to, guys. You need to know, how do you get the best policy? Because there are a lot of downfalls if you're not careful. The biggest one, of course, is how does the insurance agent set them up? You need to make sure you get an insurance agent that does what's right for you every single time. An insurance agent that would set up a policy on you like they would on their own family members, on their own parents or their spouse or themselves even. You want somebody who does that. That's one thing that if you will let us throw our hat in the ring, we do that consistently every single time. We guarantee you'll get the best ROI possible out of these policies. The lowest cost, highest return that you can get on a kind of policy. If you're willing to look into that more, reach out to us at moneyripples.com. Go in the infinite banking section. We can help you out right now.